purpose of this video is to illustrate how the accounting for pensions is done, pensions and post-retirement benefits. So this particular section can be a little overwhelming, and I have tried to organize some of the things that occur or that we need to account for using this worksheet. And the first thing I'll say is the way this is set up is anything that is any calculations that you'll do under these 5 columns are the things that eventually end up on the journal entries. And then on the right side here we have the excuse me, the projected benefit obligation and the actual fair value of the plan asset. So this is what the actuaries are tracking, and then this is what the trustee or the investment firm that is handling the plan is telling us. So let's start out with something that may be a little complicated, or not complicated, but confuses students sometimes. We are not directly inputting this into our books, the PBO. And at the same time, we're not directly putting in the fair value of the plan assets. So what we do in our accounting is we account for the net of these two. So if at any point in time what is projected to be owed is greater than what the plan is worth, then at that point we have a pension liability. And that's what I'm trying to illustrate right here. So you have a liability whenever the amount you owe or projection of what you will owe is greater than the plan asset fair market value. And then the opposite is true. If your plan assets are worth more than the PBO, then at that point you're in a pension asset position. So what we report on our financial statements is this netting of these two items. Nevertheless, we are tracking what's going on in PBO and the plan asset itself as we do the accounting. Okay, so the first thing is, at any point in time you'll have some beginning balances. There could be beginning balances for the prior service costs, any gains or losses related to other comprehensive income, and the actual pension asset or liability position, and then these two items. So the best way is to always start out with your beginning balances, whether that is 0 or something else. It's good practice just to write that down. Now, I have a little arrow here that is making a notation that I'll address a little later, so don't worry about that. The way I've organized this is in a way so that at least it makes a little bit of sense for me, so hopefully this helps you in this organization. And it doesn't matter what order you go in. I label these A, B, C, and so on, but truly it does not matter what order you take on this, okay? So here's the first thing. During any period in time, you will have the service costs related to this pension. And just to be clear, this accounting relates to a defined benefit plan, okay? Not a defined contribution plan. This is for a defined benefit plan. So each period, the employer has to estimate, and this is done with the aid of the actuaries, and whatever amount that estimate is for the service cost of employees, we need to include that as an amount to pension expense. So this is where I say you debit pension expense, or it increases pension expense. And at the same time, we can think of it increasing the liability. Now, remember, even though this is actually going to end up as part of our journal entry, this credit that I'm referring to right here will not end up directly in our journal entry. That's going to end up indirectly as the pension asset and liability balance. And you'll see how that works out at the end. But in the meantime, it helps for us to visualize it as an additional liability. Then interest costs involved during the period are the next item on the pension worksheet. And just like, since this is a liability, think of it as a loan that you owe. So as time passes, you're accruing interest on this, and the interest is computed based on the beginning balance. That's what this T minus 1 is. So I'm just using this reference as T to equal time, and then if I say T minus 1, that would be the beginning of the period or the end of the last period, Okay, so just for illustration purposes, think of t minus 1 as the beginning of the period and t as the end of the period. So to compute the interest cost, you'll need the PBO balance at the beginning, so it's this amount, times the rate that is being used. And that adds to pension expense, and it increases the liability PBO. Then if any contributions are made by the employer, any cash contributions are made during the period, then obviously that comes out of cash account as a credit, and it goes directly as a debit to the plan asset. So the amount of cash that is being given by the employer is going to be handed over to whoever is administering that pension plan. And that's why that increases the actual plan asset itself. Okay, and I note here that this is the employer making payments to the plan. Okay, so if you see ER, that's the employer. Then, if during the period the benefits are paid to retirees, any benefits that are paid to retirees, that comes out of the plan assets. Okay, because and then that reduces the liability of the PBO. So that money is coming out of the actual plan asset itself. So we're not paying that directly to the retirees. If you notice, we make, or when I say we, I'm referring to the employer. The employer makes the contributions into the plan, and then as benefits are paid out, it comes out of the plan as such. Okay? All right, so those are pretty straightforward, A through D. So now let's talk about a few things that are more confusing. Or can be more confusing. The first one is, I have this reference here as the next letter being E, but if you notice, I have E1 and E2. So these work together, and that's why I group them in similar color right here so that you can think of them as one. Throughout the course of a business, it is common for the employees and the employer to renegotiate terms of employment, including retirement benefits. So when that occurs, it could be that the employer grants some additional benefits based on prior service. And that's what this is. This PSC is prior service cost. So if for whatever reason there's an amendment and we need to add to the PBO, in other words, to the pension plan, then that's done right here as such. And that amount of additional cost is initially, since it's going to be distributed over many years and is based on a prior service, initially we put it in this section of other comprehensive income for the full amount. Okay, and then that in turn increases the projected benefit obligation that we have. In other words, what we will owe. Now, look at what's happening here. This particular amount is sort of a catch-up amount, if you want to think of it that way. So because of that, we're not going to directly put it into pension expense immediately. All right, we'll put the full amount in other comprehensive income as an expense. Think of it that way, other comprehensive income, a reduction to other comprehensive income. But then over time, okay, over time, that's when we're going to amortize that amount into pension expense. And the amortization can be done based on the years of service or a straight line amortization. And for now, let's not let this be the issue, okay? So we have some large amount here, whatever the amount may be, and we're going to slowly remove it with a credit over time, and then that amortization amount, that fractional amount, will be going into pension expense, not the original full amount. And the idea is simple. We are granting a service, or we are granting pension benefits to periods that occurred in the past, and now the idea is that those amounts should be amortized over the term, over a longer period than just that date of the amendment. Okay, so that's what's going on with the amortization of prior service costs. So in itself, an amendment for granting prior service cost benefits is not going to affect pension expense, but it will affect OCI. and then the amortization of that amount is what affects pension expense. Okay? So that's those two items that sometimes are a little confusing. The next one can be quite confusing as well. Okay? So part of what we do in the pension is we track what's going on with, by the way, I just repeated the titles here just for ease of visualization here. But, you know, throughout the period or throughout the company's, what am I trying to say? Throughout, you know, as time passes, my apologies, as time passes, we're constantly looking at what the worth of that plan asset is. So during each period, if we have a gain, okay, then that makes the plan obviously worth more, and that reduces pension expense. So if the actual return on the plan itself, based on market conditions, maybe the stock market is going up and that affects us positively. Well, in those periods where the return is actually increasing, that reduces the expense. And then the opposite is true. If we have a period where prices go down and such our plan asset, the value of our plan asset goes down, then at that point, then we recognize more expense for pension expense. Now, here's where it can get a little complicated. All right, so let me try to simplify this. Let me remove this extra arrow or parentheses here. Okay, so this is the actual return, right? And if for some reason the actual return differs from the expected return during the period. So in other words, we had an expectation that the value of the plan asset was going to go up by some amount X. And if it went up by some amount X exactly, based on our expectations, then we would credit pension expense, and then we would debit the plan asset, right? And then nothing else would be done. You would not have this F2 section here that I'm going to describe in a minute. Now, on the other hand, if you had expectations of the return on the plan, right? You had some expectations on return, and the expectations were different than the actual returns, then at that point we have to start taking that unexpected amount into OCI. And the idea is this: over the long term, our expectations should more or less align with the actual returns of the plan. Okay, so hear me out very carefully. Over time, in the long term, our expectations should align with what the actual returns are. So in the periods that it does not, we're going to remove that unexpected or that surprise component and put it into gain or loss of OCI. So let me back up a second. I just said this here accounts for any differences between the expected and unexpected, right? Returns. So you can think of the expected return on the asset based on whatever the plan asset was worth at the beginning of the period. Again, this is T minus 1 times some return, expected return, right? And based on that computation, you have some expectation of what the return should be. That's what this is right here. And if your actual return, which is what we recorded here, differs, then that difference is going to be reversed out right here. So notice how if I have a gain, the expense goes down, right? If I have an actual return, actual gain, actual positive gain. But if part of that gain is an unexpected amount, then I'm going to reverse it out of there. I'm going to take it out of there and put it into a credit to OCI. And that's what we're doing here. So when you first look at this, you say, well, why am I going to debit because of a gain? It might seem counterintuitive to look at it on its own. But the idea is that when you're doing this debit, you're reversing the unexpected or surprise component so that you can put it in OCI. And I meant to I meant to put dashed lines around all of this here so that we know that they are related. So bear with me one second here while I do this. There we go. Okay, so if you notice, I put, just because I have part of this is also related to the blue area. So for this reason, that's why I did the dotted lines for these. Okay, so for the dotted lines, you can think of it as being related. And F2 right here, that's this computation, is the offset to F1 due to unexpected or surprise components. So let me actually write that in there. Offsets F1 for unexpected returns. And keep in mind that the unexpected returns can be gains and losses. So you could have expectations of losses as well. And the market's going down, so you expect losses. And if that expectation is very different from the actual return, then that's something that needs to be accounted as well. Okay? So far, we've seen a couple of things where we've been dealing with OCI. The first one was when we grant prior service costs, where we input that full amount into prior service cost OCI, and then little by little it gets amortized to pension expense. Then here, we're seeing where pension expense is affected by actual return, and we are possibly removing some from that pension expense to put it into OCI, gains and losses of an OCI. All right, so over time, the expectation is that this possibly will zero out, because in some periods you will have unexpected gains, and in some periods you will have unexpected losses. So if everything's going well, eventually this will start decreasing and it's a non-issue. But if it starts getting very large, then we have to do something, and I'll explain in a minute, all right, what that do something means. And just, if you're curious, it relates to this idea here that I initially said, hold off and I'll explain. It deals with this corridor amortization. All right, but let's not go there yet. Okay, this is a lot of information at once. Okay, so we've addressed what we do with the actual return, and then what needs to be done with unexpected returns related to that period. All right, the other thing that can occur is unexpected gains or losses due to actuarial changes. And this could be based on many attributes that the actuaries reestimate, and then all of a sudden what the expected projected benefit obligation is changes because of these actuarial changes. So if for some reason it's in our favor and it's a gain, then what that does is, it's probably easier to look at it from this perspective. If what we owe decreases, then at that point we can reduce the PBO with a debit, and then the amount is put into OCI as a credit. And then the opposite is true for the loss. Okay, so these are changes that are outside of our control that can affect our PBO, and the actuaries are the ones that will notify us of this. Maybe there is a change in the expected life of certain employees, or other things related to that. Maybe there is like in the case of a pandemic, where the life expectancies have come down a little bit. That also can affect. So there's many things that are outside of our control that the actuaries will tell us, and those things are accounted for as such in the gains and losses of OCI. Now, notice this, and this is also tricky, okay? As the OCI gains and losses go up and down, the expectation is that they will tend to offset each other in the long run. Okay, so if that is the case, sometimes you have a gain here, sometimes you have a loss here. So overall, the OCI gain and loss is being offset. If, on the other hand, it continues to grow, because maybe we have gains and it just continues to grow, then we have to do this test where we look at how large the gain and loss from OCI is at each period. And that's where this note comes here and says these, oh, I'm sorry, this should be F2, and then this should be G. My apologies. I've changed this worksheet so many times to try to make it a little bit more understandable that I forget a few things. Okay, so this says the following. If the balance due to F2, which is this stuff, and then the balance due to G, which is this stuff, if they offset each other, that's fine. But if for some reason the other comprehensive income at the beginning of the period, T minus 1, is greater than 10% of something, and don't worry about the something yet, but if it's greater than 10% of something, then we need to amortize some of it. Again, don't worry about what this corridor thing is yet. But what you need to understand big picture is once this becomes large enough that it's the balance is greater than 10% of something, then we will start removing it out of OCI. Notice how we're doing this. So in other words, if you have a large debit balance in here, you're going to have to start crediting it. And that will end up increasing the pension expense. And you know what? Let me remove these minuses here because that can be more confusing. The idea with the amortization here is if you have a debit balance that's getting too large, then obviously you need to do the opposite, which is credit that to start slowly smoothing out some of that earnings or some of that gain or loss into pension expense. Okay, so let me repeat that again. As this balance, over time, these balances can offset each other, and it's not an issue, okay, because the balance in gain or loss of OCI never goes above this 10% of something. But if at any time at the beginning of each period you test it and you say, hey, listen, let's see what this balance is, and the balance starts getting too large, 10%, greater than 10% of some amount, then during that period you're going to need to start amortizing some of it out into pension expense. Now the beauty of this is that we're allowing, and I hope you can appreciate this, we're allowing these fluctuations that are coming in to not affect pension expense immediately. Okay, we're allowing them to sort of flow on their own under OCI, and then as needed, we'll start taking some of it out slowly into pension expense. So it's a system where we smooth the pension expense amount over time. Okay, so now let's talk about what this 10% threshold is. Okay, to compute this, to perform this test, we do the 10% corridor test. And what we will do is we will take the beginning balance of PBO or the fair market value of the plan assets at the beginning of the period. We'll choose the larger of these two. Okay, so first choose which one is larger. Whichever one is larger, then you apply 10% to it. And then it's that computation, the 10% of the larger of those two, that you compare to your OCI balance at the beginning of the period. If for some reason your OCI balance is bigger than the 10%, and that could be on the positive or on the negative, that's why it's called a corridor, then that's where you need to start amortizing that amount outside of the 10%. Okay? So in other words, let me just throw some numbers so it seems a little easier. Let's say the OCI is $100, and I compute the corridor amount. And the corridor amount gives me $90. Well, what that means is that OCI is too large, because OCI is larger. OCI at $100 is larger than 90. So the amount that I need to start amortizing is not the whole $100, but just the difference, the $10 outside of that acceptable amount. And that acceptable amount, by the way, is the corridor. Think of it as a hallway. Anything outside of that hallway, that's the amount you need to amortize. And that's what this is doing right here. Okay? So what is the amount of amortization? the amount of amortization is going to be that difference between OCI and the corridor amount, which we just talked about. So in my example right here, if this is 100 and the corridor is 90, you get $10. But you're not going to amortize the whole $10. That $10 or that difference is going to be amortized over the average service life of the employees. Okay? So that we slowly get that excess $10 into pension expense. And the reason we're doing that slowly is because next month, things can flip around. And it was wise to not overdo the adjustment over here. Okay, so think of this process as a way to slowly get that into pension expense without overdoing it possibly. Now things can change, of course. All right. So now what happens to the journal entry at the end of the period? Oh, by the way, before I get there, notice how I say, okay, this is the ending balance of OCI gains and losses, right? So this would be ending balance at period T, and I'm just going to call that amount D, okay, for reference here. Amount D now is used for the corridor test next period in T plus 1. All right, so let me go back to my initial note right here. Notice how when we started this whole thing, I said first input your beginning balances, right? Then look at the beginning balance in OCI gains and losses and test it for possible corridor amortization. So what are you going to do? We already talked about this. You're going to get 10% of whichever one is larger, either this amount or this amount. So whatever amount is larger, you'll get 10% of that and compare it to this amount. And I put if BB equals, well, you know what, that's not very well written. I can call this, I would have to change this. I'm going to change it just because I did that, okay? So if BB, we're going to call that beginning balance YY. Bear with me, please. And then, oh, I know what I did. My apologies. Okay, let's not go there. Okay, let's not do that. So I'm saying the 10% of the larger of the PBO or the plan assets, I'm going to call ZZ. Okay? I know it's a lot of letters, but I'm trying to give you a framework from which to work on, a generic one that you can apply to other areas. So then I say, okay, if you take this beginning balance, that's what I'm using here, BB. And it probably wasn't the best choice of name for it because BB exists here, BB exists here. But you know what I'm saying. If this BB, if this beginning balance is less than the ZZ amount computed right here, then you don't have to amortize. You're within the corridor and you're okay. But if that BB amount, this amount right here, is greater than ZZ, then you're going to have to amortize over the service life. Okay, so this is kind of going full circle here. This is what I was describing right here, and then what I just described right here. So hopefully that can help you in going through some of these problems related to pension obligations. Now, last thing I'll mention here is the journal entry itself. So this amount from the netting of all this, so we started with service costs, interest cost, amortization of prior service costs, actual return, and then the adjustment for unexpected amounts, and then possibly the amortization of amounts outside of the corridor for gain and losses related to OCI. Once you do that, you net those out, and that's A. And that's in your journal entry what goes right here. Next, column B, cash. This is what you paid, so this is directly in here. Okay? Now, for OCI prior service costs and OCI gains and losses, I write in here a little note that says use the amounts within. So this is not the C amount, and the D amount is not what goes in the journal entry. What goes in the journal entry is you'll have to go within. That's what I mean by the amounts within. And whatever amounts are within in the worksheet here, that's what goes in there. Okay? Any amounts that you have related to prior service costs, which would be right here. Same thing for OCI gains and losses. Get the amounts within, not the D amount. So I would get all these amounts related to the period, these right here, and that's the amount that would go into OCI gains and losses, right? So you just get one value out of this. And then lastly, this figure right here, the pension asset or liability, is going to be your plug figure. Now, the plug figure, and there's different ways of looking at this, okay? But I you know, the way I see it is as such. And I can also see it the other way, and I'll explain what the other way is. Once you figure this out, you put your pension asset or liability. If it ends up with a debit, you have an asset. If it ends up with if you need a debit, it's an asset. And if you need a credit, you have a liability. That amount should also correspond to whatever comes out right here. So in other words, when you total up all the amounts here for the plan assets from the beginning, you include all of this. That'll give you an ending balance right here. And then same thing for the PBO, you do the same thing. Whatever determination you make right here should end up giving you the ending balance that corresponds to this. So this is a way to check your work. So if for some reason, let's just make believe here that PBO is 100 and the plan asset is worth 110. PBO, what you owe is 100, and then what it's worth is 110. So you would end up with an ending balance as a pension asset of 10. Well, when you do this plug amount, that, in consideration with the beginning balance, should net out to this $10 that you need right here. So that's a way to check whether you did your work correctly. This will align with whatever this comes out to be. All right. So I know this was a long video, and pensions is a very detailed accounting that needs to be done. So hopefully this pension worksheet can help you, and the way I illustrated it can help you understand and make the reading and the homework exercises easier.